Let me welcome Nandish Shah, who is joining us on the show right now from Motilal Oswal Financial Services. A very good afternoon and thank you so much for your time. And a lot of sector churning is underway, but one such sector that is buzzing away is actually the metal pack. If you can help us understand what's your current outlook on the metal, and is it really looking interesting to you at this point in time?
Thanks for having me. Currently, we are positive on the metal space, especially on the ferrous and the non-ferrous part both. Uh, on the steel part, we like NMDC, JSW Steel, and Tata Steel. And on the non-ferrous part, we like Vedanta and Hindalco.
That's the take coming in on metal, and those are some of the stocks you're liking. Let's just take a look at the flash on the bottom of the screen, and after you've got some FMCG staples names like HUL and Dabur that have come out and reduced their prices. You also have Mother Dairy that's been cutting their price of milk and other dairy products as well. Nandish, your take on how much the GST rationalization could boost consumption overall in FMCG, because staples maybe not that much, but what about discretionary?
So we expect that the discretionary consumption is likely to pick up post this, cut in GST rates. We also feel that consumer discretionary is also likely to see some pickup because since last about 9 to 12 months, there has been hardly any pickup in the consumer staple side. Now with inflation coming down and with GST rate also been cut, we expect some consumption boost happening across the board.
Right. Okay. Kunal, staples, that's not a pocket that you would want to trade, right? FMCG?
Not really as of now, Aisha, because it lacks momentum, and I think we've seen FMCG performing very well in that phase when the markets were into a lot of volatility, choppiness, uncertainty, correction, etc. So I think in that phase, FMCG did well, and the moment the markets got a whiff, that this could be a stable recovery, and you might see the maybe the global issues, etc., ironing out. I think that's where you've seen FMCG stocks take a pause, and the money's moved back into the traditional high beta or the rate sensitives, etc. So I think in that sense, it's better to just about wait out for a point where these stocks may start to look attractive. Maybe a retracement towards their individual 20-day moving averages or 50-day moving averages depends on how far these stocks are placed above those levels. I think would be a good retracement point to add these names.
Okay, the one other stock which has been in focus today is Swiggy, and they have launched a new app called Toins for affordable food delivery options, and the prices on the app range from as low as 49 rupees to a maximum of 250 per order. In fact, we've compared Swiggy's offering with the other existing platforms as well and try and understand the difference over here. Anjali, in fact, my colleague is here with more insight.
Right. So Swiggy has launched a brand new app called Toins, which is going to focus specifically on affordable food delivery options. Now this has been launched as a pilot currently only in few select key areas in Pune, and it will have offerings mostly in the range of 49 rupees till 250 rupees, which is largely the affordable segment. But what is it that is different between this new app versus the main delivery app that Swiggy has? Well, one is that there will be no surge fee on this one even during peak hours, and it will also attract a lower platform fee of rupees 12 versus rupees 15 that we see on the main app. And it will also have parity with offline prices, which means the prices that you will see on menu cards in restaurants is what you will see on this app as well. So those are the major key differences between the existing Swiggy app and this new app. We also compared the prices or the total final price that you pay for a particular item, and what we found here was that the same item was listed at 225 on Swiggy, whereas it was listed for 200 and then discounted to 149 on Toins. There was also a delivery fee of 41 rupees without a Swiggy One membership that was on the main app versus 0 on Toins, which has free delivery on orders above 99 rupees. Additionally, no packaging charges were levied, and the restaurant GST was also lower given that the cost of the item was lower, and platform fee again we can see a 3 rupee difference, which comes out to a difference of almost 80% of a price differential was seen between Toing and the existing Swiggy app, which means that Swiggy is really going all guns blazing into the affordable segment. Now, there are a few things to set context on why this app has been launched. Sources told us that this is to largely cater to the affordable category, and in a shareholders letter, Swiggy had earlier said that they will ensure that peers don't get a clear opening, and they had also launched other offerings like the 99 store within the Swiggy app as well as Snack, both of which focused on the affordable segment. At the same time, we have rivals like Rapido that are entering into the food delivery space again with affordable options, with them asking restaurants to put at least 2 items under 150 and therefore lower prices on such platforms. Swiggy also has ownership in Rapido, about 12% that they are also looking to sell, which means overall Swiggy wants to make sure that they capture the affordable segment as well, and this new offering, this new app is a step in that direction.
Okay, Anjali, thanks so much for taking us through that. So that's on Swiggy's new launch, Toing. And Nandish, your view on this entire competition that we're seeing evolving in the quick commerce, quick food delivery, and now if I could, introduce a new category, it's affordable food delivery, because you have a lot of competition that's going to be brewing up here pretty soon now that Swiggy has forayed into this. Your take on what the competition looks like and your preferred bet between Swiggy and Zomato?
So we have been positive on both Zomato as well as Swiggy, and currently our preferred bet is Swiggy, with almost about 15 to 20% of the growth coming from the food delivery business, and with Instamart also being a market leader in some of the spaces where they are connected. Currently we like Swiggy in terms of valuation also.
Yeah, definitely. Valuation comfort does favor Swiggy as of now. But Kunal, now that you have enough chart data on Swiggy, I mean, not as much as Zomato for sure, tell me what's looking like a stronger one.
Yeah, of course, Eternal or Zomato is the strongest one. But, even Swiggy on its own space is trying to get back into a phase of recovery. So, when you do a like-to-like comparison, there was a point where Zomato Eternal was at 40 rupees or 45 rupees. The stock formed a base and then start to move up higher. There was a point where I think, if I'm not wrong, for 10 or 11 consecutive quarters, the stock gave positive returns. Now, you try and so that tells you the speed and the steep prices the stock had seen in the recovery post that. That's not something which we're seeing for Swiggy. And for Swiggy, I think it's been just about a very steady recovery so far. I think in the last 3 odd months from March, April somewhere, when the stock bottomed out at 300 mark, we've seen the stock gradually moving up to that 400, 430 mark. So it's a different chart altogether. Of course, maybe not as strong in terms of momentum, but then, there are times when stocks just about try to, take a lot of time to try and recover and get back into a breakout mode. The lifetime high for Swiggy has been around 600, 620 plus mark. So I think in that zone, there is a lot of catch up and covering up the stock has to do when it has to, break past about those life high levels. But I believe that the initial work in the prices, I think, has been done. The base has been formed at the 300 levels, and gradually I believe that the stock should look attractive. So traders who are looking to buy over here, I would suggest that you should have a medium to longest term time frame if you're looking to chip into these names.
Okay, so that's the take on Swiggy and Zomato on the charts. Kunal, I remember that you were also positive on Nykaa a while ago. And why I'm talking about Nykaa while we're talking about Swiggy and Zomato is that today when the government has come out with their list of FAQs on GST, they've come out with an FAQ on who is actually going to bear the brunt of that 18% delivery on local services. And that is now the problem of the e-commerce operators and not the people who are responsible for delivery. So that FAQ has come out today. So this could also impact Nykaa to some extent and their delivery fleet. So that is how I'm trying to connect Swiggy, Zomato with a Nykaa, because I also remember you were quite positive on Nykaa. Is that view still there?
Yeah, it's still there. In fact, it's the 7th consecutive month of price action positive for Nykaa. So I'm sure, that, on the basis of price recovery, maybe the stock could just stall over here for a couple of months because of that steep price rally in the last 7 months. But then this tells you that this has been a one-off major trend breakout for the stock price. And remember, I think 2021-22, when the stock listed post the listing, the high was around 420 or 440 about for Nykaa. And from there, the stock had fallen down to, I think, 120 or 130 levels. So after falling almost till 1/3, the stock is trying to get back into a repair process. 7 consecutive months of price rally. for the stock, and it indicates that we are looking at a major turnaround for the stock.
All right, so that's about some of these newish tech companies. But moving on, and all eyes will be on the much-awaited FOMC meeting, where the street is anticipating the first rate cut of 25 basis points this year. Let me take it across to Varun Dubey, who is standing by to tell us what more to expect. Varun.
Well, so the street is estimating a 25 basis point rate cut in the September meeting of FOMC, and after 2.5 years, that is after June 2023, this would be the first rate cut in the US markets. And the Fed range, which is around 4.25 to 4.5, will actually start moving down. And it is not only this time, street is also expecting a rate cut going forward. If you look at the Reuters poll of 107 economists, around 105 are expecting a rate cut in the September policy, and around 60% of the economists are also expecting a rate cut in the coming policies as well. So a total of around 50 basis point of rate cut is expected in the calendar year 2025, and that is 60% of the economists are expecting a 50 basis point rate cut in calendar year 2025. And also some are expecting further rate cuts in calendar year 2026. So they are expecting a total of 75 basis point rate cut from here on till the next year. So the rate cut cycle is again to start after 2.5 years. Now there are several factors which are actually leading to the rate cuts. No doubt, if you look at the inflation numbers, they are actually expected to inch up because of the tariff war that is going on. But yes, if you look at the other economic data points of the US market, especially the unemployment data, that is something which is actually worrisome. And if you also remember, during the Jackson Hole Symposium, the Fed chairman was actually sounding unemployment data to inch up going forward in the US markets, and this is one of the important data points because of which street is expecting a 25 basis rate cut in the September policy, and also going ahead you might see a series of rate cut in the US markets. So after finally 2.5 years, that is Jan 2023, the rate cut cycle in the US market is about to start with a 25 basis rate cut in the September policy.
Absolutely. That's what one is anticipating from the Fed and what the trend has been. But yes, all eyes on the Fed this time around. Perhaps finally, after a very, very long time, they're going to finally move on the curve and begin easing rates. But that said, just looking at the index right now, by the way, we're at the day's highs. Let's just bring up the Nifty intraday graph. We're currently at 25,235. So we've suddenly shot up in the last few odd minutes or so. What looked like we are just going to about make it to the 25,100 mark. We've eked out a good 164 points up in the green right now. And I just want to bring up the list of the contributors as to what is it that's actually leading and moving up the Nifty. It was banks. I mean, that's where the first signs of a pickup actually came in. You had the likes of a Kotak, as well as Axis, which are actually leading within the private banking space. But I think now even HDFC Bank and ICICI Bank have somewhat picked up, or at least beginning to inch up a little bit. Still not participating in today's move, but at least those stocks have kind of turned tide, or at least are attempting to do so. Kunal, within banks, where do you see leadership next? Because today it's really about Kotak and Axis all the way.
Yeah, so I think ICICI Bank is something to watch out for. I believe, when I look at the sensitivity of prices across the private sector banking names, it started off with ICICI Bank showing that some promise and confidence, when it managed to make a comeback. I think yesterday, if I'm not wrong, where the stock managed to come back to that 14, 20, 30 mark. There was a point where, there was some sort of a confidence which is brewing back again, that maybe the private sector banking stocks could also try and come back again. Then we look at this as a relative positioning. ICICI Bank and HDFC Bank are the two names which are still trading, above their longer term averages. Compare this with the likes of Kotak, Axis Bank, etc. I think except for the last couple of days of price action, these stocks were holding, far below their longer term averages. So which means that there's a lot of catch up which these stocks have to do. But I believe in that sense, once the confidence comes back into a particular index, then the larger cap names are the ones which, charge premium. And I think in that sense, I would believe ICICI Bank could be one of the stronger candidates over here. If the stock manages to break past about this 1430, 1435 level on the short-term charts, I would probably expect that this could aid, a further up move of at least another couple of percentage points on the Bank Nifty.
All right, so that's about the banking majors. Yes, of course, very good moves coming in on Kotak Mahindra Bank, which is the top gainer since the start of the day. What's not doing well within the paint basket is actually Asian Paints, because towards the second half for the past two to three consecutive trading sessions, we are seeing that the selling pressure is intensifying on Asian Paints, and even today as well, you will see that the stock is down almost 1%, and even in the past 7 days, it's almost a 4% correction that we are getting to see. Kunal, a quick chart check by you on Asian Paints. How do you see this counter on the charts? Because given the fact that we will be entering the festive season in a big way, no such excitement on the paint major.
Yeah, no excitement on the stock, and in fact, every rally has been sold into for Asian Paints. I remember, I think just about last week or so, the stock was at 2570, 2580 levels, and from there, you've seen the stock correcting 100 odd points. So it's not the intensity of price correction, but it's just that, closer to a breakout point when you see suddenly the stock reversing and then, losing out the advantage which the stock would probably have garnered after this major price recovery from a huge underperforming zone. That puts off, short-term traders. So I believe in that context, maybe the stock would just about remain at these, current price ranges, 24, 25, 100 could be a pivot support for the stock price. And on the upside, you might look at 2600 as a resistance. So no major call of a trend for Asian Paints as of now on the short-term charts.
Now I want to ask you about a stock that is suddenly, it's really high and rate today. We've not seen this move coming on Redington. I don't know if you track Redington. It's a stock you haven't spoken about in a very long time. A 20% spike up coming in. During the mid-market day, we did see some block deal action happening on this stock, but nothing significant in terms of news flow for such a big move. What is your reading on the charts for Redington?
Yeah, I tracked the stock in between when it was up 12-13%, but it was difficult to fathom the view because the setup as such, because for the last 1 month, the entire month of August, and I think prior to that, the end of July, the stock was actually going through a major corrective phase. So from 330 levels, the stock had fallen down to almost 30%, 240, 230 thereabouts. And after that kind of a price correction, there was no major setup on volumes, etc. So I'm sure traders who are looking at a contraband Redington, they would be caught in for a surprise on the upside. I'm not sure whether the stock will see a very similar kind of a follow-through up move, because when you don't see generally a major volume pattern before a strong move, that move generally fizzles out, or it requires a lot of confidence from traders to try and buy the stock whenever the stock dips post that. So I actually believe that maybe over the next couple of days, once this move settles down, the stock may actually come back into a corrective phase and come back to say 260, 270 mark.
Okay, that's that on Redington, and Nandish is also back with us. Nandish, within the entire EMS space, what is it that's looking interesting to you, and the whole debate about, how much of the run-up has already happened, whether valuations are comfortable or not? What is your preferred list?
So in EMS the segment, we like Keynes Technologies, Dixon and Amber Enterprises are our top picks.
Okay, so that's the take coming in on the EMS space. Nandish, anything else looking good to you? We've not spoken about pharma, but recently we've seen lots of US FDA action coming in, lots of new launches, the likes of Zydus launching a lot of pet care drugs today. Your take on the pharma space, Nandish?
So in the pharma space, we like companies who are basically for focusing on the CDMO part. We also like the hospital space. So we are not that positive on the generic space as such, but we are positive on CDMO players like Laurus, Blue Jet Health.
In healthcare and hospitals, like you were saying, what's the preferred lot? Not like there are many listed options in any case.
So yes, so in the hospital space, we like Apollo Hospitals and Max Healthcare.
Hospitals is the preferred counter within the healthcare space, so let's watch out for that as well. But other than that, we are seeing very decent moves or rather good moves coming in on select real estate counters. See the likes of DLF that has shot up, even Lodha is holding up, and even stocks like Prestige Estates, they are also doing very well. But Nandish, can you help us understand why is there a renewed excitement with respect to the real estate counters, especially some of these large caps? A renewed interest is seen, at least on the stock price. But anything incremental that you are picking up and you wish to highlight what's happening in the real estate basket?
So with GST rates coming down, especially on the cement side, we feel that over a period of time, the biggest beneficiary will be the real estate companies like what is it, DLF and Lodha, and in, uh, uh, and in the southern-based real estate companies, we like Prestige. So these are, I guess, with interest rate coming down and affordable housing segment even becoming much more attractive, real estate space can see a good action in the near term, in the short to medium term.
All right, so those are some of the factors that is definitely is looking exciting to the investors, and Nandish also shared some of the top picks that he's liking at this point in time. But Kunal, a quick chart check by you as well. How do you see the whole real estate pack, and anything in particular that is looking good to you? Because today morning there was a report coming in from Antique on Oberoi Realty. I see at least that stock hasn't participated much, but any other stock that is looking good to you?
So I think DLF, Godrej Properties and Oberoi Realty are the top three names over here. Prestige also could be a good buy at current levels, because of the way the stocks have underperformed. Look at it this way, that, the real estate basket, I think just 2 months back, end of May or start of June, was almost at 1,050, 1,060. And from there, we saw the index falling 200 points. That's almost 20%. So I think in that context, you are looking at potentially that if the markets recover, the sectors start to show signs of recovery, we may look at the realty pack at least trying to claw back from that 200-point correction and come closer to at least the midpoint of this 200-point drop. So maybe closer to 950, 975 is where you can expect the real estate index to head towards. That's at least another 7% from current price juncture. And that could probably mean that maybe the individual stocks or few of the performing names could rally up at least 7 to 10%. So there seems to be a good room for a swing trade over here for many of the real estate stocks.
Today is turning out to be one of those days when you actually wish the trading day was a little longer, because 20 more points and we should actually make it to 25,300 on the Nifty spot. We're just 50 points shy actually off that mark right now. 24,250 is where we're at, and to think of it, we had one of the flattest days yesterday, an extremely quiet start today as well, and then in the second half that pickup has actually happened, pretty much drawn up by blue chip names like Kotak, L&T, M&M, Eicher, Bharti. They've all contributed to today's move. A couple of these technology plays as well have participated in the Nifty move today, and everything from an Infi to a Wipro, HCL Technologies, TCS, TechM, they've all held up quite smartly. And then, of course, what turned tide was also ICICI Bank, HDFC Bank, although these stocks have closed in flat, but Reliance has actually picked up. And if we can just bring up the intraday graph, because up until mid-session, Reliance was lying quiet, and then you saw a pickup in Reliance, and perhaps that's what's rubbed off on the Nifty as well.